Hold on.
Brian, you may begin.
Thank you. Good morning, everyone. On behalf of the U.S. Commercial Service, we welcome all of you to our second part of our 5-part trade finance series during Export Week 2023. Today, our federal partners from SBA and XM, plus other subject matter experts, will educate you, the U.S. exporter, about export credit insurance, payment terms, letters of credit, foreign exchange, and just best tips and best practices. My name is Brian Beams, and I am your Deputy Team Leader for ITA's Financial Services team and your host for today's session. Our producer of the entire series is Anthony Sargis, based in our Connecticut office. Before I hand over the controls to today's moderator, a couple of items to mention. Everyone is currently on listen-only mode. This session will be recorded. If you object to that, please disconnect at this time. Participants can write in questions into the Q&A feature at any time during the presentation. Next week, we will send out the recordings and resource materials of all 5 sessions to all the registrants. Lastly, the views and opinions expressed in this presentation may not reflect the official policy and or position of the U.S. government. I will now turn it over to Joe Raycraft with the Small Business Administration's Office of International Trade. Joe?
Thanks, Brian, and welcome everyone, and thank you for joining us today for Export Week's presentation on export credit insurance, payment terms, letters of credit, and foreign exchange. As you can see on the slide, this is our Day 2 event. Yesterday, we covered government resources and all the services that are available to small business exporters. If you join us the rest of the week, tomorrow we have an export business planning webinar that will feature a business advisor from the Small Business Development Center who will walk us through kind of that export business planning and strategy format. And then on Thursday, there's a webinar on grant funding and how that can be used to support exporters. We'll hear about the SBA's State Trade Expansion Program and also Food Exports branded program. And then finally, on Friday, we're going to wrap up with financing for small business exports. And that's going to be a webinar including myself from SBA and Richard Foy from Exim Bank. Rich Foy is on the line today, and he'll be participating in today's event. So today you're going to learn about an important financing tool, and it's export credit insurance. We're going to learn what it is, how it works, and what is the benefit that it provides to small business exporters, and how export credit insurance can be used as a sales tool to generate higher export sales. We also have a team from Citizens Bank today. It's going to provide a presentation on getting paid on your export sales, the advantages and risks of the different types of payment terms that are offered, anywhere from cash in advance to letters of credit and open account. The bank's presentation will also discuss a little bit about foreign exchange and standby letters of credit and some best practices. With the Citizens Bank team, we have Gerson De Silva. He's Vice President and Relationship Manager within the Business Banking Group at Citizens Bank. We're also joined by Carmel Dambreville, who's Vice President of Trade Services, and Aaron Paddock, Vice President, Global Markets and Foreign Currency or Foreign Exchange. So to kick things off, I think we'll move to Gerson. And if you wouldn't mind, talking about, I'm sorry, are we going to go to export credit insurance first?
Yeah, Tom's on. I think you can probably jump right into it, Joe.
Perfect. Okay, so we're going to pivot back to export credit insurance. I want to introduce Richard Foy from the Export-Import Bank of the U.S. and Tom Malloy from Risk Protection International. And if you guys would just take a minute to introduce yourselves, your organizations, and what you do. And Rich, I'll start with you.
Thanks, Joe. My name is Richard Foy. I'm the Regional Director for Export-Import Bank of the United States, otherwise known as Exim Bank. I am responsible for the Northeast region of the United States. We operate out of other regional offices around the U.S., so you can reach out to your local person, as it were, by visiting our website, xm.gov. We're fortunate to have Tom Malloy, who's longtime professional in trade credit, and he's going to present trade credit to you, the concept, the benefits, and so on. So I'll turn that over to Tom now.
Thanks, Rich. Hi, everybody. My name's Tom Malloy. I'm managing partner of Risk Protection International. We're a 40-year-old insurance agency that specializes in insuring accounts receivable and a few other related lines. The presentation I have today is a PowerPoint consisting of maybe a dozen slides, which I'll run through rather quickly. And what I've been asked to do is to kind of give a 10,000-foot view of what credit insurance is, simply some of the broad categories of how it works, and then offline, if anybody has any additional questions or anything else that you want us to delve into, we can certainly deal with that later. So let me start off, and I see the slides are up on the presentation online, which is great. So again, my portion of today's presentation is just to talk a little bit about accounts receivable insurance and how it interacts with accounts receivable and dealing with risks related to international trade. Now, simply put, credit insurance or accounts receivable insurance is just insuring the payment risk of a receivable. If you're selling cash in advance, then you don't really have a receivable. You've been paid before your product even leaves the shores. You don't need to think about these types of risks. But if you're in a competitive environment and you're selling product overseas and your customers are asking you to give them some terms to pay, then you are in fact incurring a foreign risk. So credit insurance is simply a seller, an exporter in country A, selling products to a buyer or a series of buyers in countries B, C, D, E, F, G. That's really all it is. There's a parallel line, which is domestic credit insurance, which is just insuring transactions that don't go cross-border. Connecticut company selling to a company in Iowa, that would be a domestic credit receivable, and that could be done through credit insurance. Connecticut company selling to Canada or Germany or France, that's an export receivable, and that could be covered through export credit insurance. You just pop over to the next slide, if you would, please. So if we look at companies, whether you're a manufacturing company, whether you're a trading company, or anything in between, when we look at balance sheets, we see that receivables are usually a fairly good chunk of your asset base, as are plant, machinery, inventory, etc. All of those other receivables are generally covered in some form of insurance. So, for example, you have a facility, you have a plant, you may have taken a mortgage on it. You wouldn't be able to get the mortgage unless you had fire insurance on the plant. You have inventories, those are insured against theft, deterioration, fire risks, things like that. So what we see on a balance sheet is most assets have some sort of an insurance backing, but the one area that is often overlooked are accounts receivable, and they can be substantial on a balance sheet. It could be 20, 30, 40, 50% of your asset base. And this is where the insurance that we're talking about jumps in and protects those receivables, which may in fact be uninsured. If you flip the next slide, please. Okay, so this is fairly obvious, but consequences of bad debt. If you have a sale that goes south and you have to write that receivable off, obviously first you have a loss. That can make you a little bit weary about doing business again in that marketplace. You may want to think about going back to cash in advance, and that has a potential drag on your sales potential. So bad debt generally creates problems for companies. The insurance is there to minimize the risk of bad debt by creating a secondary source of repayment. If the buyer fails to honor their promise to pay you, generally you can then look to the insurance company to step in and substitute and pay you where the buyer did not. And then that insurance company will generally try to collect the debt from that delinquent buyer. Very simply how it works. Flip to the next screen if you would. Um, Reasons or some of the factors that go into companies thinking about using credit insurance. And you can see there's 6 here that we've just highlighted. It's interesting. Rich and I just put together a deal for a company actually in New Jersey. In fact, the transaction just shipped 2 weeks ago. They paid the premiums. The policy is in place. And what this was a very large deal for a fairly small company. This company is in the telecommunication area. They picked up a $500,000 order from a very nice, very stable looking company in Germany, but they'd never done business with this company before. And a $500,000 order was extremely lumpy. It was very large and outside of their normal order flow. So they were concerned. So they approached us because they had this concentration of risk with this one buyer. It was a new customer. It was a cross-border transaction, and it was a special order because they had to produce this product specifically for that buyer. And then to win the order, they had to grant credit terms. So it really met 4 or 5 of these sort of parameters on the screen that highlighted why they should think about credit insurance. In this particular order, they had to basically sell the $500,000 with 6 payments, basically at 30, 60, 90, 120, 150, and 180 days. So it was a sixth of a payment every 30 days. And when we were speaking with the owner, what they were concerned about is if this order went south and if they couldn't collect, put a huge dent into their financial position, into their borrowings, and into their overall cash flow. So Exim Bank, Rich's operation, they were able to insure this for, I think that what was a premium, Rich? It was like maybe 90 cents. It was less than 1% of the insured sales to get the deal done. Client started with an application, took a couple weeks to get the buyer vetted, but say from start to finish, 2 weeks, 3 weeks, they went from having a new order to having it fully covered to actually closing the deal. Those are the types of scenarios that we see all the time, and that would generally drive somebody to consider insurance. Flip to the next screen, if you would. And again, just to define credit insurance, what export credit insurance is, it's a management tool, and it basically is a secondary source of repayment if your buyer fails to pay. So you've done what you've promised, you built the product, you've sold the product, you delivered the product. Now the onus is on the buyer to honor their commitment, and if they fail, this is where the credit insurance pops in. Jump to the next slide, if we would. And types of things that are covered. These are, again, just very broadly, what insurance is covering you for is if the foreign buyer goes bankrupt, and we're all familiar with Chapter 7 and 11 bankruptcies and different types of bankruptcies in various countries. If a customer takes an order, goes bankrupt, and you don't get paid, claimable event under the policy. But more importantly, the second bullet here, protracted default. That's where you sell the product. You say you give 30-day terms. The buyer says, okay, I'll pay you in 30 days. 30 days comes and goes, and 60 days and 90 days. And it just drags on, and you're getting promises. Checks in the mail. We have a little cash flow problem. We're going to pay you eventually, on and on and on it goes. You've made all reasonable efforts to collect. The buyer's not insolvent. They're not bankrupt. They're still operating, as far as you know. They may be financially strained. You have no idea. They're in another country. Well, that's a protracted default that can be claimed under the policy. And then the final area is a very broad category called what we call political risks. And those are macro events that impact and impinge on the international transaction. You sell product to, well, a classic example. We have one of our clients sold product to the Ukraine. War breaks out, economy goes to hell. They're not getting paid. So we're filing claims in that particular scenario under the political facet of the policy. 3 very broad categories. Each one has particular requirements, but again, from a 10,000 foot view, very broad coverage of your accounts receivable. Let's flip to the next slide, if we may. And the question is, okay, so we know what credit insurance generally does. Where do you get it? Who provides it? 2 broad sources. We have the government program, which is what Rich will talk about. That's the Export-Import Bank. It's a U.S. government agency. It was formed through enabling legislation in the 30s. It's been operating for 70, 80 years. And they very much were an innovator and a market leader in the export credit insurance industry in the United States. In fact, without them, it wouldn't have existed. So in the early years, the 30s, 40s, 50s, 60s, and 70s, they were very much innovative, providing a great amount of coverage for U.S. customers, U.S. companies. In the last 20, 30 years, we've seen a proliferation of private underwriters, multi-line, single line underwriters that also offer credit insurance. They offer domestic credit insurance for U.S. transactions. They offer export credit transactions. And they're just another venue to go to. So we can look at government program, we can look at private programs, and there's constantly new players coming in. Just flip to the next slide if you would. Exim Bank is what Rich will talk about. That's a U.S. government agency and very strong provider of credit insurance. Flip to the next slide if we may. And again, the private underwriters that operate in the U.S. are there's about a dozen. You know, any given year, some come in, some come out, some expand their programs, but they're leading companies. Some of the names you may have known. In fact, let's flip to the next slide just quickly, if we may. Some of the logos of the major companies, AIG, which is a multi-line company that we all know, and you, in fact, may use some of these companies in your business to insure other types of transactions apart from receivables, Allianz, Coface, et cetera. And again, new companies coming in, additional companies entering the market every year. So we have a broad base of companies providing cover. We talked about the insurance providing various types of benefits. The key thing is it gives you a secondary source of collection if in the event that your buyer does not pay. It can do a number of other things. It can be you can use it as a sales tool to try to take on new orders or additional orders, or maybe go a little bit beyond your comfort zone and actually grant credit terms or slightly longer terms to help you win business. You can use the insurance for whatever purpose that it fits your particular need. If it's strictly risk protection, so be it. If you want to use it as a sales tool, if you want to tie it into working with the SBA or working with your bank to try to develop lines of financing, you can see benefit and use it in that particular fashion. And it can be an overlay to your credit function. So if you have a credit department in your company, the credit insurance works very much hand in hand with your credit department. If you don't have a defined credit function, the credit insurance can actually fill some of those credit function needs for you. Again, there are different ways to structure coverages, and there are different types of programs, but there's probably a fit for whatever you need to do. Let's flip to the next slide if we may. And again, how it works. A very simple process is all insurance requires some sort of an application. It's just basically who, why, what, where. What are you doing? What type of product are you selling? Where are you selling? Where do you want to sell? What type of terms are you providing? What's your experience been? That's the general sort of 5 or 6 questions that are asked. And then it can become a little more granular if you want to get into a lot of specifics about what you're doing and how you're trying to structure the policy. But it's a fairly simple process. It takes a couple of weeks to put the policy together. And again, it's just usually an application that generates some back and forth questions with the insurance underwriters, and then they'll structure an offer for you. Policies generally are written for a 1-year period, and they're renewed annually, but again, they can be shorter or longer. They typically cover a substantial portion of the receivable that you generate, 90-95% on average. There are different ways of writing the policy. You can actually schedule every buyer to your policy. You can structure policies where there's some grant of authority where you can just automatically cover the foreign buyers via your internal credit practices. All of this has to be laid out in the discovery and in the application process. And the premiums are usually structured as a percentage of whatever sales flow under the policy. In the example we gave before of the single buyer customer in Germany, the premium there was like roughly, I think, 90 or 94 cents against $500,000. So that client paid a premium of under $600 to cover a $500,000 order. Let's flip to the final stage and how policies can be structured. All over the board. We mentioned single transaction, the German account. That's a single buyer policy. You can take a pool of receivables, say 5 or 6 countries, or a particular product line that you want to cover and cover all of the receivables within that particular area, or you can structure the policy covering virtually all of your eligible export receivables. Whole turnover, single buyer, select risk. There's all different ways to skin this. The key thing is the application process brings us to define what those are and what your needs are and what your desires are. And that is a quick and dirty view of credit insurance.
Thanks, Tom. I'll just jump in here real quick. This excellent presentation by Tom to give an overview of the benefits of credit insurance. XM Bank, we're a government agency, as Tom stated. We kind of fill the gaps in the private market. We don't compete with the private market. We work very closely with brokers such as Tom. They are an advocate for you. They're the middleman between the insurer and you, the exporter. So they're a vital piece here. So I invite anybody that has any interest in this to contact me. We'll share my contact information. Tom's information will also be shared, and we'll just move on here to citizens. So I'll turn it over to you, Joe.
Perfect, thanks. Before we do, I just have a quick question for Tom, kind of a follow-up, and just kind of, I mean, it was, thank you again, great presentation, very clear, very understandable. Just with kind of the economic uncertainty that's out there globally, are you seeing an increase in usage of this credit insurance? Again, just because people are a little bit nervous about what's going on.
Definitely. I would say over the last 3 years, we've seen a real spike in applications and new policies written. I think it started really with the onset of COVID and the disruption to the economic flows that we saw here in the U.S. and internationally. And then, of course, some of the turmoils and the Russian-Ukraine situation is problematic. And we're seeing I think a spike of risks and deals going bad in Latin America. So it's definitely the volume has definitely picked up. The claims volumes have gone up substantially in the last, say, 18 months. Seeing a lot more claims than we did the prior 2 years.
Yeah. And thank you for kind of covering the cost of it. I think you gave a good idea of what it is. In my sense and experience working with it, it's a fairly inexpensive financing tool that is very powerful for a small business. I've seen, and I know you've covered both, it covers both the commercial and the political risk associated with a transaction. One way I've seen it used is a customer of a company that, long-term customer, long-term relationship. And this overseas customer was in a country where they suffered from a very significant currency devaluation. And it wasn't that they didn't want to pay, it's that they couldn't pay because now their currency was worth literally half of what it was the week before. So as a result of the delayed payment, they did end up submitting a claim. So
sure,
that's something.
And that transaction, the U.S. company sold in U.S. dollars, so the devaluation cost really was borne by the buyer.
Exactly. Well, Tom, I thank you. Appreciate your time. And I'm sure there'll be some questions in the chat for later on. Next, I want to move to our Citizens Bank team for the second part of the presentation, where we're talking about, again, getting paid, payment terms, letters of credit, and foreign exchange. Jerson, I'd like to bring you back and hand it over to you.
I'm taking lots of good notes. Thanks for having me over here. I'm excited to be here. Export Week, I can't believe it's here. We've been talking about this for quite some time, and I can speak on behalf of my colleagues. I'm really happy to be here to talk to the audience. Yeah, so again, I'm Jerson Da Silva. I am a relationship manager for Citizens Bank in Connecticut. I work around the beautiful shoreline of Connecticut. A business banker essentially is an advisor to a business where we are part of a team. I am the go-to person for a company where I am their resource and I'm the go-to guy for all things business. clients are good at everything that they do. I tell them, don't be good at my job. So I'm always trying to look for solutions to help their lives easier. Whether it's banking on the go, if I can help you clients with solutions, with receiving funds faster, or sometimes delaying receivables. I do a lot of financing. I help clients finance their working capital needs when there's AR involved. I help clients with equipment. I help clients with real estate. I do a great deal of helping clients with mergers, buying out different companies, buying out partners, and we're also an SBA preferred lender. So it's all very exciting. As a relationship manager, I spend a lot of time helping clients with fraud prevention, fraud mitigation tools. We see a lot of check fraud, a lot of electronic fraud. So I'm always, advising clients on that. But something that's underutilized, and I am very proud to be part here of Citizens Bank, is our international trade arm. If you go to the next slide, please. We have a team in-house who are I call them my gurus, my go-to. Every time a client is doing lots of volume in importing or exporting, or they're starting to think about it, importing and exporting, I usually sit down with them and understand the implications of these transactions. And again, I rely on two of my colleagues here. Next slide, please. I have Aaron Paddock, who works in foreign exchange, is going to talk a little bit later. He has a presentation for all of you. Eric is a great resource, not just for me, for the whole bank. I'm glad to have Aaron by my side. And of course, we have Carmel Dimmerville, who's going to talk next. Carmel is a trade specialist, and she is, again, somebody who I rely on with questions about guaranteed payments and the tools that she has in place to help business clients get paid. With that said, I want to pass the baton to my colleague Carmel Dimmerville to talk about trade finance.
Thank you, Justin. I appreciate it. Thank you for having me here this morning. I really appreciate it. And I applaud all the audience for being here, simply because I'm thinking if you're here this morning, it's because you are new to exporting, or you are exporting and you are trying to get the proper information in order to conduct your business wisely. So for that, I applaud you, because having the information before you enter into a foreign market is absolutely necessary. So I think this is good. So again, my name is Carmel Dimmerville. I work for Citizens Bank. I've been there for about 10 years. Prior to that, I worked at Bank of America, and all my career have been in trade from one capacity to the other. I started in the operations area, examining documents, moved on to account management, moved over to product, all in trade. And then finally, I joined the trade sales team some years back, and now I do the business banking market. I used to do the larger corporates. Now I concentrate on the business market. So one of the things, we can move to the next slide if possible. One of the things that, and I think the prior speaker, Tom, covered some of it with the credit insurance. If you are going into a foreign market and you've never sold to a foreign country before, it's necessary for you to know what you're getting yourselves into from every aspect. And more importantly, if you are planning on selling your product and making a profit, you want to make sure that your risks are mitigated in every way, shape, or form. You want to make sure you get paid. You want to make sure that you have control of your goods until you get paid. So credit risk is the first one that's really important. You don't know who your buyer is. You don't know who you're selling to. Again, I believe, is it Tom O'Brien that spoke about that? Going into an international market and not knowing the culture, not knowing the country, not knowing your buyer. There are certain countries that if you're selling, okay, I'll use Africa as an example. You can trade rice, you can sell rice to Africa, but you wouldn't sell cotton because they grow cotton. So there are certain things that you need to know about your market. You need to know about the culture, especially if, let's say you're selling clothes to certain countries. Well, due to the culture, maybe some women cannot wear certain clothing. So it's, believe it or not, most people are not thinking about those things, but those are things to consider when you are entering a foreign market. Then, of course, you have the political risk. We don't even need to go too far because the Ukraine and Russia war right now, it's in everybody's mind. And I'll just give you a quick example, and I know we press for time, but I have a client that a few years ago did a huge $15 million deal by selling coal to Russia. And they did it under a letter of credit. They got paid, but he didn't like the fees that he paid. So he went and he did a shipment for $5 million last year, and he did it straight to the buyer. Well, the war happened and funds could not get out of Russia. So he's calling me. He's like, well, Kamel, what can we do? Not much we can do. You've already studied the process, but if you had an LC and your product was on the water, we would not deliver it. We would find a way to bring it back shore, or send it to another party that would be able to purchase it in another country, because we would still have control of the goods, having the documents here. FX risk, and I think someone mentioned it. The currency fluctuates, of course. If you're gonna buy, I would say you get a dual invoice, one in foreign currency, one in US dollars. And you may consider having a contract later on, just because the rates fluctuates, and what you think you're getting in payment may not be if the currency has gotten devalued. So we really advise, credit insurance is absolutely a great way to go, but a second way of mitigating all this is a letter of credit. And let me just, before I go into a letter of credit, let's go to the next slide, and we'll just talk about the payment terms. So when you are trading internationally, there are 4 ways to do it. 4 ways. You could do a cash in advance. And if you are doing cash in advance, I applaud you, because you don't need credit insurance. You don't need an LC, because you're getting the funds prior to sending your product. And it's wonderful for you, but it's not great for your importer. So whoever is buying from you and from whatever country will have the same concerns that you on the other side of the coin would have. Okay, I'm sending a wire transfer for $500,000 to buy product from somebody that I don't know. Am I going to get the product that I ordered that's in the purchase and sell, that's in the purchase order, or am I going to get the product on time? Am I going to get the product at all? So all of that is a concern. It's a concern for the buyer. It's a concern for the seller. So now you've got the second method of payment, which is open account. Open account is the reverse. So if you go and you ship your goods and you get on your knees and you pray that everything works out well, that you do get paid, and you get paid on time. And I believe they mentioned about terms, credit terms. So imagine that you're selling to a foreign buyer at 180 days. So you're not only sending your goods, but you're going to give them terms, and you're waiting for 180 days to get paid. In the meantime, you've got a problem with the cash conversion cycle, because you do need the money in order to make other widgets to sell to other people. So by not having your cash fast, quickly, it impairs your business, right? So the third method of payment we have is a cut between cash in advance open account and a letter of credit. So that's a documentary collection. Documentary collections are less secure than a letter of credit. And the reason why, there's no credit involved. Your buyer doesn't need to have a line of credit with their bank. The only thing they're agreeing to do is having the paperwork go through the banking system. And what do I mean by that? If you are shipping, you're either shipping by air or you're shipping on a container by ship. And the mode of transport, whether it's the bill of lading or the airway bill, is what the importer needs in order to clear the goods. those paperwork goes to the banking channel. Again, we more like a conduit. The bank acts like a conduit. So you the buyer, you the seller, you send the paperwork to the bank and you say to Citizens Bank, I'm sending you the paperwork that covers this shipment. We then send it to the foreign buyer's bank, and the foreign buyer's bank holds on to the paperwork. They do not release it until payment is made. Now, how is this advantageous? Well, the comfort level here is that your buyer will not get a hold of the goods unless they pay. And 9 times out of 10, they do pay. I haven't seen one yet where they, usually when this happens, they do pay, unless there's a huge circumstances as to why they don't. But it's still not the safest way to transact, especially if you're doing it overseas. And most importantly is if you are giving them terms. If you're giving them terms, they get a hold of the documents, they can pick up the goods, and basically it's to turn those goods into cash and to pay you later. But they don't have an obligation to pay. So if they don't pay under a documentary collection with terms, you now have to think about the legal system. And we don't want to go there with the legal system in different countries and how that works. So the instrument that works the best, it's been around for over 300 years. They have yet been able to, with all the technology improvement and so forth, they have not been able to change it. They haven't changed it because it works. And that's a letter of credit. If your buyer can give you a letter of credit, automatically that should put you at ease. Simply because in order to obtain a letter of credit from their bank, they have to have a relationship with that bank. That's one thing. Second, they either have a line of credit or they're going to put up the cash to open the letter of credit. So what you know at that point is you have a guarantee of payment. So once you say to your client, okay, fine, we're doing this and I want payment under a letter of credit, and they said, okay, we agree. You can rest assured that you have an 89% chance of getting paid. And I said 89, I don't say 100, because getting paid is contingent upon you preparing the documents in accordance to the terms and conditions of the letter of credit. So you want to get paid, you need to perform in accordance to what the letter of credit requires. Now, I heard, I mentioned terms when I was talking about documentary collection. Under letter of credit, let's say that this is a new buyer and they want 180 days term, and you kind of like, that's a lot, I don't know them. If you're doing a letter of credit, you can actually extend terms, and this is where you would go to your bank and said, I don't want to wait 180 days. I want this LC confirmed and discounted. So you have the opportunity, if your bank has a credit relationship with that foreign bank, your bank can pay you on day one rather than 180 days. So we actually finance the draft on behalf of the importer. And then we pay you on day one. So you shouldn't miss a payment based on the fact that the company is asking for terms if you're dealing under a letter of credit. So those are the type of things to know, that don't refuse right away, but speak to your banker, speak to your advisors to find out if you have options, because there are options. You can go to the next slide. So what are the advantages? And this is the thing that I think I mentioned, I covered a little bit of what that the slide is saying. The advantages of using a letter of credit is you are assured of getting paid, because you are no longer looking at your buyer to pay you. You're looking at their bank. Their bank is taking a credit position. Their bank is telling you, the exporter, don't worry. If you meet the terms and conditions, it's me, the bank, that's going to pay you. Don't worry about your buyer. And so with that in mind, you really can feel comfortable in sending your goods overseas. Again, there's a misconception that there's such a thing as a revocable letters of credit. There is no such thing. All letters of credit are irrevocable. They cannot be canceled. The buyer or seller cannot on a whim say, oh, I don't want to do this deal, I want to cancel. For a letter of credit to be canceled, both parties have to agree. And unless both parties agree, we cannot cancel the LC. So this is a good thing. Like I said, it's a good thing to know. I've already covered the credit worthiness of the buyer, because obviously if they're gonna open an LC, like I said, it's either they have a credit relationship, and obviously they have the cash to secure it if they don't have a credit relationship. What the bank does, what we do on your behalf is we negotiate the terms and conditions. In cases where you're new to exporting, we at Citizens Bank, what we do is I provide new time exporters with what you call a letter of credit routing guide. I can send a copy of that to Joe, and he can distribute it to anybody in the audience that wants a copy. And that's just in the perfect world, that's what a letter of credit is supposed to look like. So I would work one-on-one with an exporter to just say to them, okay, this is what you want on the LC. The letter of credit is as much yours as it is the person that's issuing it, because that is your method of payment. So to have that all drawn out, meaning you think about the freight, you think about who's paying for the freight, you think about who's paying for the insurance, you think about, the documentation. You don't want them requesting documentation that you can't present. I've seen cases where they actually send requirements and they built in the discrepancy on the LC. So which is why it's imperative that you have someone that can guide you through that process. That could say, okay, you want them removing this, you want them, adding that. Again, the bank acts as your intermediary. We the one that's representing you. We're not communicating with your buyer. We are communicating with your buyer's bank. And anything that you want to change, anything that you want to add, you come to us and we go to the bank and we do an amendment to whatever with the letter of credit if you need to change the terms and condition. And again, if we are able to, and I'm going to give a very brief example, and I know I'm pressed for time. Some years back, there was some issues with Venezuela, and some companies that were buying oil, that was selling, I'm sorry, not buying, but selling to Venezuela. When the crisis happened, at the time I worked for Bank of America, they still had to pay under the letter of credit because everything was in conformity, everything was in compliance. Doesn't matter what was going on. We had confirmed letters of credit, they had to pay. So this is where I really, I do encourage anybody exporting to at least think of using any kind of international trade tool, whether it's credit insurance or letters of credit. You can move on to the next.
Carmel, that's great, great information, especially, on the letters of credit and how important they are as a payment mechanism. I'm curious if you can just comment briefly on, generally on costs for issuing those. Again, there would be costs on the buyer side. Would there be any costs on the exporter side?
Absolutely. So it's really when you're thinking about the size of a transaction and you think about the cost of the LC, it's actually it's worth it. So to advise, and the good thing when we do an export, the client doesn't need a credit relationship per se. We just need a DDA. So that's the first thing. The cost for advising the LC to a client is $150. So any charges for the bank in the US would be for the account of the seller, for the exporter, and any charges pertaining to the foreign transaction would be to the foreign bank, would be for the account of the importer. So any charges overseas, the importer would bear it. Any charges here, the exporter would bear it. Perfect. And the only thing that costs a little bit, I mentioned confirmation, because we are financing. If the client wants us to pay them ahead, if there's a transaction that's 180 days and we're discounting it, there's like a 2% fee, and based on the country, the rates can change. So that is to be discussed. It's it's per country, per transaction, per terms. There's a whole bunch of different criterias.
Because we're a little pressed on time, I know you were going to cover some standby letters of credit. I don't know if you can maybe take a minute to do that.
I can do that in 1 second. Standby letters of credit in international trade in terms of exporters, it's best when there's an open account transaction. if you are selling on an open account and let's say you're giving them terms, you're not looking for the bank to discount it, your buyer opening up a standby letter of credit would be perfect. What the standby does, it gives you a guarantee, and I mean a guarantee, that if anything happens, you can get paid. So though you're giving them 180 days, if 181 days appears, you don't get paid, you can draw on that standby. It's an instrument that is standing by in case there's non-performance. It's used for a variety of reasons, but for an exporter, it would be used on non-payment of goods. And that's my spill on standby.
Okay, perfect.
I don't think we have another slide. I think the other slide is the questions.
Yeah, and I think
the differences.
We're gonna share the slide deck with the audience so they can review the questions. I think the questions are really good just in terms of them thinking about, you know, what they need to have in place when they're gonna start exporting, having a good export plan, and other things to think about. So that's something they can review later on.
Absolutely.
So now I want to move to Aaron, who is the foreign exchange expert from Citizens Bank. And just to talk a little bit, you know, we can just kind of do maybe a Q&A format, Aaron, just to help make it a little bit more efficient. But if you could, you know, just briefly introduce yourself and what you do. And you know, first question would be, you know, what are the foreign exchange solutions that Citizens Bank offers to its clients?
Thanks, Joe. Appreciate it. Can you hear me okay?
I can.
Fantastic. So Aaron Paddock from Citizens Bank. Been in foreign exchange for about 12 years now. I sit on the foreign exchange desk working out of Massachusetts. And to answer the question, we have a full service foreign exchange offering, which we're excited to offer to our business banking clients, our small business clients. And I think what sets us apart, differentiates us a bit, Joe, and everybody that we're fortunate to have participating here today, is that we have all the capabilities and foreign exchange solutions of our larger competitors. So that's spot transactions. We can offer hedging solutions, forward contracts, options, and just general hedging solutions that allow our customers to minimize risk. So really happy to be here today and to be able to offer these solutions that I mentioned, not just to our largest clients, but to our small business clients, which I think and I know separates us a bit. So happy to be here.
Okay, excellent. Thanks. And I'm not a foreign currency guy, but you know, I'm assuming that there's a lot of volatility in that market, and you know, sometimes it's hard for, you know, the average business person to keep up with. And just curious, you know, what services are available to minimize risk, and you know, how you guide some of your clients.
Sure, thanks. You're right. Lots of volatility in the currency markets these days. And what comes to mind for exporters specifically is we can offer foreign currency accounts. So accounts, this is pretty unique. I've done some homework on this, and while there are some other institutions that offer it, we can do them quickly. They're held in-house here at Citizens. This would allow an exporter to receive payment in the local currency, whether it's euros, pounds, Canadian dollars, Japanese yen, etc. Hold the funds in that currency until it's an advantageous time, either something they hear from us, or have their particular view of the market, or it just makes sense to convert funds at that time into dollars, into their operating account. So a foreign currency account would be one. Second would be to work with Jerson and his team with a foreign exchange line of credit. FX line of credit would allow you to lock in exchange rates. And in the case of exporters, it would be selling the foreign currency. So locking in exchange rates for the future is a pretty valuable tool as well. So just real quickly, if you knew you were going to be receiving funds, say 1 month, 2 months, and 6 months from now for a product or a service that you're delivering overseas, we could actually give you a rate today for those transactions in the future. So even if the market was to move in your favor, just a peace of mind of knowing what your exchange rate is going to be up to 1 year in the future has proven to be very valuable for our customers. So those are a couple things that come to mind.
No, that's good. Now, for companies that, typically when they make a quotation to an overseas buyer, it's in US dollars.
Mhm.
So what would be the advantage for me as a small business to actually accept foreign currency versus, for the US dollar, which is really easy for me. Now, if I'm accepting foreign currency, it's going to cause confusion with my CFO. Like, what are the real benefits to me by doing that?
Sure. So I think there's a couple. The first is that someone sitting in let's say Japan, for example, if you're selling into an Asian market, they might understand pricing in their local currency better than they understand US dollars. So I think that opens up sales opportunities just to give someone the option, whether it's a consumer, individual, or a business. So someone earlier mentioned dual currency invoicing, which I think is powerful and a good idea here. So to give the ability to remit or for them to send payments in US dollars and their local currency, as long as you're getting a good exchange rate, and that's something that we would take care of here on the FX desk, is going to be key. So one advantage, understanding that there may be more sales opportunity to offer people the ability to pay in their local currency. Also, with those hedging products that I mentioned before, you can eliminate and minimize risk there by knowing what your exchange rates would be in the future. If the market was to move against you, you'd be glad that you had locked in those rates.
Yeah, absolutely. So with everything going on in our local banking sector, just curious, has there been a big effect on foreign currency markets?
Yeah, we see people moving to what I would call the safety currencies, the majors: US dollars, euros, yen, Canadian dollars, and then we've also seen what I would call a pretty significant uptick in companies, import and export companies that are wanting to lock in exchange rates to minimize the risk. That there, someone that I might have suggested opening up an account in a foreign currency a couple years ago, and they would need time to think about it, and that makes sense, are now coming back and saying, let's open up that account, right? I want to minimize my risk by having the ability to hold currency in kind, just simply to have the rates locked in a sense, by getting the funds in, holding them in a foreign currency account, and then converting them when it makes sense for our company here locally.
Perfect. And just before we get to some Q&A, we get about 5 minutes left. Just quick observation from you, looking ahead on what might be coming in 2023, 24. Any quick observations you have?
I would just say stay close to your bankers, whether it's Citizens or elsewhere. There's some uncertainty out there that's not a secret. Consider doing business in the local currency if it makes sense for you. Hopefully, I've made some compelling reasons why it might make sense to at least consider it. Understand that there are ways to minimize risk out there from everybody we've heard from on the panel. One of the themes that I'm picking up on, especially from Carmel's products and services, are that there's ways to protect yourself. So whether it's insurance, minimizing foreign exchange risk, it seems more important now than ever to know that these resources are out there for you, and to minimize risk wherever you can, and you need to sometimes lean on your banking partners to do so. So that's what we're here for.
Yeah, no, well said, and I agree. Your banker is your trusted advisor, so it's always good to keep in touch with them. And then I would echo Carmel's, I think she said this at the beginning, get the information up front, be proactive, right? Learn about this stuff now and not when it's too late. So I think that was a really good message. Brian, I'll turn it over to you if there's anything in the Q&A that we need to address.
All right, thank you, everyone. And remember, everyone, we will be accepting any written in questions in either the Q&A or the chat feature. This is your time to ask questions. Please don't be shy. I'm looking at, scroll down. What is the pricing formula for hedging, say 3 to 4 or 3 months and 6 months? I think that, let me see.
It's probably for Aaron, but I don't know.
Yeah,
if
I think it
enough
is Aaron
information for him
I
to answer
think that would be for me. David, it's a great question. There's a little more to it than I think I can sum up here in a couple minutes. I will look to connect with you, David, and my contact information is here as well. It would depend on the currency and a couple of other factors that I could sum up really quick to you in an email, which I'd love to do. So aaron.paddock@citizensbank.com. Let's connect if we could. I'd need a little bit more time to kind of explain the 3 and 6 month hedge, which I'd love to do. I can do it today.
All right. And can you receive FX hold if for a period and then remit it to a vendor in that country with that same currency?
Yep, absolutely. So that would be the foreign currency account would be the way to do it. So if you're looking to hold funds in a certain currency, foreign currency account's the way to do it. So we'll use euros, for example. Euros come in, you can hold them in euros and then deliver them out in euros. A lot of people will use this one to avoid the cost of currency conversions. Makes sense, right? So we are able to offer that, Victor, with our foreign currency accounts. Can't do, every account